Welcome to Investors Insights, where today's topic is market fireworks. A lot going on this week. We hope that everyone is excited about the holiday. Before I talk about how stocks can be a great way to fight off inflation, and before Ty talks about seasonality, Trey, talk about jobs number. We're going to be looking at this very carefully and why it's important.
Yeah, thanks, Bobby. So it is a holiday shortened week, but before everyone takes off on Friday, we will get a special jobs number on Thursday. Gives us a new payroll update. And why it's so important right now is two things. One, it gives a great indication to the Federal Reserve of how the economy is going. The Fed has two mandates: full employment and low inflation. So employment is half their job, and so that's a very big data point that they look at, and so that's why we look at it. But then secondly, jobs data has been surprisingly strong for the last few months. And so is that a blip in a chart that you can see that it just spiked up? Is it going to come back down, or is it sustainable? And that's very important to the stock market because people that are employed get to contribute to their 401ks, which goes into the stock market, which increases demand, increases prices. You got higher demand, higher jobs, higher wages. You have excess savings that contributes to the stock market. So if you have stable and growing employment, you're going to have a stable and growing stock market. So it's very big for us. If you see that reverse, you start seeing people losing jobs. They have to spend down their savings. That is a negative tailwind to the stock market. So jobs are very key to the Fed, to the stock market, and to what we're looking at. And we're going to really want to see what the wage numbers look at to see if we have had higher inflation. Many people expect that inflation to come down with gas prices coming down. But will we see wages continue to rise? That'll be very important. So very big Thursday, surprisingly big Thursday, usually big Friday. But so we'll keep our eye on that coming out this week.
Yeah, obviously that's a big number on Thursday, and hopefully it's a good number. And so we can celebrate the fireworks this weekend. So stubborn inflation continues to be a hot topic among investors and has caused a lot of uncertainty around what the Federal Reserve is going to do with interest rates. So I want to remind our viewers that one of the best ways to fight inflation is to invest in stocks, and more specifically, stocks that pay dividends. And so many investors are likely aware of the indispensable role dividends have played in the total return of the S&P 500 over time. So actually, dividends have accounted for 37.2% of the index's total return between December 31st of 1928 and December 31st of last year. So obviously, we suspect most investors are also aware of inflation's impact on their investments over time. So with that in mind, today's chart explores the extent to which dividend payments have outpaced inflation. So the time frame that we chose was 46-year period beginning December 31st of 1979 and ending December 31st of last year. And as revealed in the chart, the dividends per share paid by the companies that comprise the S&P 500 increased at a staggering pace when compared to inflation. Since 1979, the index's dividend per share increased at a compound annual growth rate of 5.88%. So for comparison, inflation has increased at an annual rate of 3.19. So dividends have been a great way to fight inflation and continue to be a great place to be. So Ty, talk about the seasonality we look at in the markets.
Yeah, we've all heard of the dog days of summer, and that doesn't mean anything different for the stock market typically. So as you can see in this chart, June 30th through kind of the rest of the year. Zero over here is June 30th date and starting from there. So the green line is when the market is positive. The red line is when the market is negative for the first half of the year. And then the blue line are all observations. And as you can see, from about now until September 1st, there's not a lot of differentiating between a good market and a bad market. You kind of have that dog days of summer where things just kind of drag on. People are out of town. Things are just happening. I'm sure we'll get plenty of news along the way. But historically speaking, they're not big events for the stock market. Then once that calendar turns to September, you really see the difference. If the market was positive for the first half of the year, you really see that performance continue. If the market was negative for the first half of the year, you see that performance continue negatively. And so we are in the positive bucket right now, which is a great sign. And hopefully that means good things to come for the second half of the year. But historically speaking, right now we're kind of in this lull period until we get to the end of the year. Doesn't have to happen that way, but history often rhymes.
Well, we're hoping that the Thursday jobs report that Trey talked about will help with seasonality. be watching that carefully. So we hope that everyone has a happy and a safe holiday weekend. If there's anything we can answer for you on anything we've discussed, please call us, email us, come see us. We love to engage with our viewers. So thanks and have a great July 4th holiday.